Walt Disney Co., trading under the ticker DIS on the NYSE, is currently sitting at $107.95 USD, reflecting a significant drop of $4.85 or 4.30% today. This downward move comes on a day that, on paper, should have been a victory lap for Bob Iger and his executive team. We are looking at a classic case of the market demanding more than just a surface-level beat, and the reality of Disney's current financial health is far more nuanced than the headlines suggest. While most investors were looking for a confirmation of the studio's return to dominance following the massive success of Avatar: Fire and Ash and Zootopia 2, the actual report revealed a complex tension between record-breaking top-line revenue and a bottom line that is being aggressively squeezed by the very growth initiatives meant to save the company. The immediate insight you need to grasp here is that Disney is no longer just battling for eyeballs in the streaming space. They are now battling their own internal cost structures as they pivot from a legacy media giant to a modern technology and experiences powerhouse. If you were following the general narrative leading up to this morning, the expectation was a clean sweep. People saw the billion-dollar box office numbers and assumed the stock would soar. The reality, however, is that Disney's entertainment division saw operating income decline by a staggering 35% despite a 7% increase in revenue. This is the curiosity loop that has the institutional desks at Fidelity and Interactive Brokers scratching their heads today. How does a company produce 3 consecutive billion-dollar hits and still see its core entertainment profits shrink? The answer lies in the massive programming and marketing costs that are the price of admission for staying relevant in the era of high-end content and the transition to digital platforms like the upcoming ESPN app. We're seeing a fundamental shift where the cost to acquire and retain a customer is rising faster than the revenue those customers generate, even with the successful implementation of password-sharing crackdowns and ad-tier growth. The common ground for most investors has been that the Parks and Experiences division is the untouchable cash cow that can cover for any of the company's other shortcomings. We often think of the parks as an impenetrable fortress of recurring revenue. However, today's data challenges that safety net. Even though the experiences segment hit a record $10 billion in revenue, the attendance figures tell a more cautious story. When you look at the 1% increase in domestic attendance, it sounds like growth. But once you factor in the comparison to last year's dip during Hurricane Milton, the reality is that visitation is essentially flat. This suggests that Disney may be hitting a ceiling on pricing power in an environment where families are becoming more selective with their discretionary spending. For those of you using a self-investing approach through platforms like Robinhood or SoFi Invest, this is a critical metric to watch because if the parks start to stagnate, the premium valuation of Disney stock becomes much harder to justify. Looking at the intraday movement, the volume is notably high, indicating that the 4.30% drop isn't just a retail panic, but involves significant institutional repositioning. We are seeing a lot of activity in individual brokerage accounts as people try to decide if this is a buy-the-dip moment or the start of a deeper correction toward the $100 support level. The macroeconomic pressure of sustained higher operating costs is the primary driver here. From labor costs at the resorts to the $110 million loss of operating income from the carriage dispute with YouTube TV, Disney is finding that its traditional levers of power are being tested. This is why tools like Schwab Intelligent Portfolios or other online investing platforms often flag these high-beta media stocks for volatility during earnings weeks. The market is pricing in the risk that Disney's turbocharged growth plan for the parks might require even more capital expenditure than previously thought, as evidenced by the $3 billion in capital spending this quarter alone. I want to pause here for a second because I'm curious about your positioning. Comment below how many shares of Disney stock you currently hold, or tell me if you think Bob Iger has actually fixed the studio's creative pipeline for the long term. Seeing your perspective helps us gauge the sentiment of the retail community versus the big institutional players at firms like Fidelity Wealth Management. When we break down what Disney actually does today, it's a far cry from the simple animation studio of the past. It's an ecosystem of content, physical experiences, and sports broadcasting. The studio business is clearly back on its feet creatively, with the company regaining its spot as the #1 global box office leader. But the business model is in a state of flux. The streaming segment, which includes Disney Plus and Hulu, finally turned an operating profit of $450 million this quarter. This is a massive milestone that shouldn't be overlooked. They're aiming for a 10% operating margin in streaming by the end of 2026 fiscal year, and the integration of OpenAI's Sora for short-form content on Disney Plus shows they're willing to experiment with new technology to drive engagement. However, the costs associated with launching new cruise ships like the Disney Destiny and the Disney Adventure are creating a temporary drag on the free cash flow, which fell to a usage of $2.28 billion this quarter. For the self-directed investor using a Fidelity trading platform or Interactive Brokers account, the technicals of DIS are currently looking for a floor. We had a nice run-up toward $112 leading into the earnings, but the inability to hold that level after beating on EPS suggests that the market was already positioned for perfection. The tension here is that Disney is firing on all cylinders operationally, yet the financial efficiency isn't quite there yet. They're spending money to make money. And in a market that is increasingly focused on profit margins and cash flow, the spending part of that equation is being scrutinized more than the making part. This is where the individual brokerage user needs to look at the long-term guidance. Management is still projecting double-digit adjusted EPS growth for the full year and is staying on track with $7 billion in share repurchases. This buyback program is a clear signal that the board believes the stock is undervalued, but the market isn't ready to agree until the margin expansion becomes more visible. One of the most interesting and perhaps overlooked aspects of the current analysis is the sports segment and the evolution of ESPN. We saw operating income in sports decline to $191 million because higher programming and production costs, specifically for college football and the NBA, are eating into the revenue gains from advertising. As Disney moves towards a full direct-to-consumer ESPN offering, the cost of these sports rights will continue to be a massive weight. If you are into online investment and follow the broader media sector, you know that the cord-cutting trend is still the giant elephant in the room. Disney is trying to build a bridge to the digital future without letting the legacy cable business crumble too fast, but it's a delicate balancing act that requires near-perfect execution. Looking ahead, the catalysts for Disney stock are plentiful but come with high execution risk. We have the maiden voyage of the Disney Adventure in Singapore scheduled for March, which will significantly expand their footprint in the Asian market. There is also the continued rollout of new themed lands like World of Frozen in Paris and Tropical Americas in Florida. These are the engines of the experiences division that justify the high capital expenditure. Furthermore, the 13% growth in streaming subscription revenue shows that Disney still has a lot of pricing power left in its digital ecosystem. If they can successfully bundle Disney Plus, Hulu, and ESPN into a unified experience that reduces churn, the profitability of the entertainment segment could see a dramatic recovery in the back half of 2026. The reality we have to face is that Disney is a company in the middle of a massive structural renovation. The expectations were that the renovation was finished, but today's price action shows the market realizes there is still more work to be done on the foundations. Whether you use SoFi Active Investing, Robinhood, or more traditional investing sites, the takeaway from this intraday move is clear. Disney is no longer a set-it-and-forget-it blue-chip stock. It has become a high-stakes play on the future of global entertainment. The gap between the $107.95 we see now and the analyst consensus price targets of $135 suggests there is significant upside if they can rein in those operating costs. But if the park's attendance continues to show hidden signs of slowing down, that $100 support level will be tested very quickly. To wrap this up, let's summarize the central insights of where Disney stands. The expectation was that record park revenue and a studio comeback would trigger a breakout. The reality is that higher production costs, carriage disputes, and flat domestic attendance have led to a 4.30% sell-off. We're seeing a company that is technically profitable and growing its top line, but struggling to convert that growth into the kind of bottom-line efficiency that Wall Street rewards. The curiosity loop remains. Can Disney's massive investments in cruise ships and new theme park attractions outpace the declining margins of traditional television and the high costs of the streaming wars? As we move forward, keep a close eye on the institutional activity. If we see large blocks of DIS being picked up at these lower levels, it would suggest that the smart money is looking past the quarterly noise and focusing on the 2020